The Fed. Here's their statement if you want to pause it and read it, or else I'll go through it briefly. Information received since the Federal Open Market Committee met in January indicates that the labor market has continued to strengthen and that economic activity has been rising at a moderate rate. That's actually a downgrade of the economy, that moderate rate, so that would indicate dovishness. Stick with me, though. Job gains have been strong in recent months, and unemployment rate has stayed low. That's good. Recent data suggests that growth rates of household spending and business fixed investment have moderated from their strong fourth quarter readings. That is, again, another downgrade. On a 12-month basis, both overall inflation and inflation for items other than food and energy — who doesn't use food and energy? I love how they don't include them — have continued to run below 2%. Market-based measures of inflation compensation have increased in recent months, but remain low. So that means the inflation read outlook is low, which is, again, now good. Survey-based measures of long-term inflation expectations are a little changed on balance. So they're not expecting a lot of inflation. Again, good. Consistent, and this is when it starts getting a little bit odd. Consistent with its statutory mandate, the committee seeks to foster maximum employment and price stability. The economic outlook has strengthened in recent months. So it's strengthened or it's moderating. So this is a contradiction here. My guess is that this is just they took pieces of the stuff, by the way, that's highlighted are the things that changed. So maybe the Fed staffers who write this stuff didn't realize what they were copying and pasting. We'll get to that in a minute with his statement. The committee expects that with further gradual adjustments in the stance of monetary policy, economic activity will expand at a moderate pace in the medium term, and labor market conditions will remain strong. Again, another upgrade. Inflation on a 12-month basis is expected to move up in coming months and to stabilize around the committee's 2% objective over the medium term. Near-term risks to the economic outlook appear roughly balanced, but the committee is monitoring inflation developments closely. All right, so this is obviously they're speaking again out of the both sides of their mouth, but we're going to get into Powell's statement. He cleared some things up. So what was I looking for here? I tweeted it out. I said what the bulls need from Powell are 1, tame inflation expectations. 2, to specifically saying they're still the data dependent. Growth outlook is stable to higher, and I wrote that the tape still feels tentative and looking for an excuse to flush. We'll talk about that in a minute. The market was trading much higher at that point, and there was a reason why I was saying that. So he has to be perfect, and price needs to stay above the VWAP, which is the volume-weighted average price. So let's go through Jerome Powell's some of the notes I took on his statement and see how it measures up to the 3 criteria that I had laid out. All right, so they raised interest rates by 1/4 point to 1.5 to 1.75%. The dot plot was 3. They were looking for 3 hikes. Potentially there could be 4 added in or whatever, but that doesn't seem like what they were looking to do here. So they said that they had 3 hikes. Now this is where it sort of, I don't want to say went off the rails, but they indicated that they're looking for 2 to 3 hikes in 2019, still all right, and then in 2020 they added in maybe an additional 2 hikes. So front end, as in 2018 to 2019, not that big of a deal, but in the out months, or the out years, they got a little bit more hawkish. And I'm going to tell you why I think they did that in a moment. So they see the Fed funds rates in 2018 being 2.13%, in 2019 2.88%, and in 2020 3.38%. That's an important number. And then they see the long term only at 2.9%. Now, we're going to get into, I should have actually had that graphic up here, but not a big deal for our current purposes. So why did they do this with the out years? I think that the big fear that these geniuses on television always talk about is the Fed inverting the yield curve, and this will steepen it up a little bit. So that's good technically for some banks, and good for I guess the run of the market that they're not going to invert the yield curve. So I think that was meant to kind of tamp that decision that fear down. Now, why could they possibly want to raise rates more in the out years and not do it now? What I think they were really basically doing was they were prepping the market now for the possibility of having to be more aggressive later. And I think they also wanted to have that now as a a quiver in there, an arrow, whatever the hell they say on television. Basically, they wanted to have that as a tool that they can now change if they need to lower, instead of lowering interest rates, which they can't do. They could, I guess they could do it, but they don't want to do it, but unless there's a recession or so on and so forth. And we're going to get into that in a minute. Powell address that as well. They can adjust their outlook, and that now is a policy tool that they can use to soothe the markets. Of course, this was lost on the intelligentsia that is on television. All right, so they talked about growth or they were talking about. Let's see. I'm just looking at my. They say that employment can get even better to 3.6% unemployment. He mentioned the aging demographic. So the participation rate is that it's improving is impressive. Oddly enough, as a follow-up to my Toys R Us section of the Weekend Review, they came out further and blamed a lot of their demise on millennials and millennials getting married later and having kids later. That, by the way, is one of the big problems for the entitlement system, particularly Social Security, and one of the reasons why I think politicians are so quick to want to bring in new immigrants to make up for their lack of birth rate, but that's a whole other conversation. Just thought that would be an interesting tidbit, that what Powell was noticing was what Toys R Us was noticing. They don't see too much inflation coming, and they talk about moderation of business activity. So that's a little bit of a dip, but then he said it was sort of solid. So again, a little bit out of both sides of the mouth. They said that the jobs market was strong and expected to stay strong, good. Inflation tame, but rising. They expected to rise to their 2% goal. They've been saying this forever. He added in this caveat that Yellen had talked about, and I think this again was missed on the intelligentsia, that they're basically okay with it going above 2% because it's been below 2% for so long. And he mentioned that symmetry again, which is what Janet Yellen had discussed, what I affectionately referred to many months ago as her come to Jesus moment. Let's see. He talked about fiscal policy being more stimulative, which they had been waiting for a while. That's the tax cuts. He talked about foreign growth being okay, although it's been moderating a little bit lately. That's my addition there. They don't want to have to do abrupt hikes, so I think that's one of the reasons why they added that they're going to do the hikes later on. Here's so this is where it went off the rails. So look, they said that they said inflation is tame, and they said that the growth outlook is stable to higher. So that he cleared that up. Their statement was a little bit more dovish. He clarified it that he thinks it's stronger, so that's good, but slightly more hawkish, I guess, in that sense. And then this is what really got, I think, the markets a little bit worried. I mentioned that here again. I want to just refresh, specifically saying that their data still it should be still data dependent. That's a bit of a typo, but it is what it is here. So they said that they don't want to change the outlook for rate hikes unless there's a significant downturn. So they're not data dependent. That means they're going to continue hiking even if the economy slows, unless it slows a lot. That's why the market didn't like what Powell had to say. Then they talked about the neutral rate. They asked if it would be, some reporter asked if it would be appropriate to raise. He basically said yes, but again, hawkish. But he said that they were very, very slowly moving higher, and it's just going to be just a little bit. But he mentioned that it's still very low. So overall, there was there was something for everyone here if you were hawkish or dovish. But overall, I would have to say that Powell's statements were a little bit more hawkish because they're not data dependent anymore. They're going to just keep hiking. So listen, I think that's tough talk, and I could almost guarantee you, given the type of president we have, if Powell does do that and the economy does start to weaken, he's not going to be Fed chairman very long. I'm just putting that out there. All right, so let's go through some of the Fed's charts. Unemployment projections are coming down. This is, of course, good, although they see the long-run rate in the outer years coming back a little bit closer to just below the 5%, which used to be the norm. I don't really want to get into my take of this about why that is what it is, but I think a lot of people have been unemployed for so long that they no longer count. GDP, here's a little bit of a problem for me, that they have it topping in 2018 and coming down in 19 and 20. And then the longer run is then again back below 2%. So the Fed in this chart kind of downgrades the growth expectations. At one side, they're saying it's strong, but they're expecting it to weaken right into the teeth as they're hiking rates. Again, this is very hawkish. This to me is again getting into dangerously low growth if you're back below 2%. So why is the Fed getting more hawkish? So this is again a chart that the market shouldn't like. This is their median projection. Then the range and the central tendency, whatever the hell that means. But the red line is what you need to look at, and they're seeing growth. Currently, it's accelerating, but they're seeing it peak out. So that's a little disturbing. So listen, I can't tell you. No one knows what's happening with growth. I will say that the rate of change has been slowing lately in some of the data. We had that great employment number, but some of the PMIs, some of the ISMs, particularly U.S. and global, have been slowing a little bit. So yeah, growth is slowing, or the rate of change of growth is slowing a little bit. And here you see it. So this, again, it makes no sense to me why they want to be more hawkish out in 2020 if they're picturing growth slowing. Inflation here, they're expecting it to come up a little bit, and then this is their 2%. Listen, they've been wrong about inflation for a while, but it has been ticking up a little bit lately, and that was mentioned on the FedEx conference call, and that's why they got zapped in the after hours. The stock went up and then kind of went down, and then the FedEx guy was talking about trade wars, which he should have kept his big mouth shut, in my opinion, but it is what it is. All right, so I talked about, we'll get into what I see meant as the ABC pattern, and I'm going to revisit these two slides later, shortly later. This was actually taken out of my video, the market profile basic look. All right, so let's talk about what happened intraday today in terms of ES. I had mentioned, remember in my tweet that I had mentioned that the auction, there wasn't a completion of the auction, and we're going to talk about that right now. So the market, again, I always like lower into the Fed. The market, in all of its infinite wisdom, got itself long. This was a bit of a short squeeze ahead of the Fed. You had a little bit of a pullback, and then initially there was a rally. So an ABC pattern is usually A, B, and then C, and that's what took place here. But then Powell, and we were on our way, I think, coming back higher. But then Powell made some of those statements, which were frankly more hawkish. I'm not going to sugarcoat it. So the market came down, and this to me was the key, the VWAP, which today closed around 20. Let me see in here, the exact-ish, basically 27.25. All right. So what's the trade setup going forward? This is to me, as Carl Icahn would say, a no-brainer. All right, so let me finish. Let me button this up first. So we had the move up here, and the auction wasn't completing, meaning there wasn't downside price discovery. Take a look at what I meant here by that. It just was the bell curve, meaning we had the up discovery that was here, and we didn't have the downside price discovery to complete the bell curve to make it look like this. This is a perfect auction intraday, Basically, the fairest price is to do, business in the meat of the move, and then you have your extremes. So here, we didn't have this. This completed the auction. Then it came back up, and I had said around here that it was, basically, it was back to the auction was completed, and you're basically reset. So the bulls were able to get a squeeze here, but then again, those hawkish comments came out, and there was a big MOC into the close, and you can see here there was a little bit of relief. So this was one tick below the prior day, and then you bounced. So the setup to me here is very obvious, and I've mentioned this many times on Fed days. I know not everyone has been following me for as long as some of you have. Many of you have been with me for many years, which I greatly appreciate. But for the newer followers and newer members, we're going to cover that now. So you have a bit of a decline here. So first and foremost, anything below the 2-day low that accepts price below here, I would say is a short, because it's a Fed day range. Who's, all the people who got long and short, who's right and who's wrong for the last 2 days? If you're below here, the shorts are right. And to me, it could come lower. If you get back up above today's VWAP, I'd say it gets more neutral to maybe more bullish. And then above this high here, the 27.33 quarter, I could say you could probably enter a little bit of a long there. And then anything above high of day today, which was 27.24 quarter, I'd say is more bullish. And we're going to talk about that in SPY terms right now, why I think that.